Meghan, I'll start with you. The fact that we're fading the gains right now, what is that indicating about the market at these levels?
Well, we would expect continued volatility, and I wouldn't be surprised to see a couple of really big up days like we've seen over the past week, because volatility we tend to think of as very negative, but it is two-way. We are still cautious on this market. We think this has a ways to go before it will be fully played out. We've seen some significant monetary policy response so far. We're waiting for fiscal. But unfortunately, what we really need is time. And that's not something that a policymaker can give us to see how this virus plays out. And we're still on the upward trajectory here in the U.S. So we think that there's more volatility to come.
So, Meghan, where's an investor to hide right now? I mean, how are you consulting your clients in this time of great volatility?
We're telling our clients to be underweight equities, but not sell out or do any knee-jerk, panic-based selling. When you do that, it is that much harder to get in at the right time. And there's so much focus on where is the bottom, when will markets go back up again. We've seen about a 25% peak to trough drawdown, which is right in the median of historical recessions. So we're pretty much there in terms of the market pricing in a recession. There's really nowhere to hide in the equity market in this type of market because even the defensives are getting sold off. But what we've seen hold up a little bit better has actually been what worked over the past year or so. Some of those growthier names, higher quality, earnings stability, those types of areas of the market. We still like some pockets of healthcare. We still like consumer staples and some consumer goods because when we do get through this, and we will get through this, we are going to be sitting at low interest rates, low mortgage rates, and we think that consumers came into this in a very good position. So consumer-based products and goods will be poised to rebound on the back end.
Yeah, and of course, low gas prices, too. Brent, some of those growthier names are names that you actually cover. I see here in the notes that you're lowering estimates across the software industry. 40 companies that you cover by 1% to 3%, that no one is immune here. That being said, where do you see more safety within your coverage universe, and where do you see the coronavirus and the broader macro economic effects having a bigger impact?
Yeah, short term, I don't think we see any safety. We still think there's probably one or two more rounds of number cuts to come. The 1% to 3% cut that we made could be a 5% to 10%. No one really knows, again, depending on the impact. But, just driving into San Francisco today, it feels like a Thanksgiving day. No one's on the roads. I mean, it's eerie. And I think when you think about many of these companies that close business at the end of March that have a direct sales force, it's going to be really tough to get deals done. So I think the first quarter is going to be really difficult. It's going to bleed into the second quarter. We have companies like Expedia and Booking are pulling guidance for the year. So I think right now the answer is no one really wants to do anything. We do like Intuit, given the safety in the tax business. It's a very well-run company. We like Adobe. The CEO was on earlier this morning. We think they're in a great position as a monopoly in the creative business. We think Microsoft will come back. But again, they're still at risk with their enterprise business. They had already pre-announced 1 month left into the quarter. So, no one's immune. It doesn't matter where you're at. But there are some great stories that are off 20 to 30+% that we think investors will come back to. So if you have a 2-year lens, we think you can take advantage of some of these. But short term, I think we still haven't probably seen the bottom yet.
And Meghan, I would think a lot of investors, particularly those who might be rebalancing their retirement portfolios, but a lot of investors have a longer window than 2 years. So why not buy now? You mentioned that we're down about 25% from the highs on the S&P. That means 33% upside to get back there. I doubt many people think that we're likely anyway to drop another 25% from here. So that means it's a decent time to buy, right?
For a long-term investor, you're getting some very attractive opportunities. We do not know how long this is going to play out, but if you do have a long enough investment horizon, absolutely, you're getting some attractive entry points for clients who have portfolios that have moved and significantly drifted from their targets. We are absolutely recommending to rebalance. And for clients who have cash on the sidelines, you're getting the opportunity to buy in at market levels that we haven't seen since 2018. We would say be patient. Don't throw it all in at once, because we could have another 5 or 10% down to go in the market. But we absolutely don't think you should try to be too cute in timing the bottom. And if you have a long horizon, we think we're going to get through this, where we'll have a contraction in the second, possibly third quarter. But we're expecting at this point a rebound in the fourth quarter, such that U.S. GDP is probably going to be about 1% for the whole year.